Kokou Agbo Bloua joins us. He's Global Head of Economics, Cross-Asset and Quant Research at Societe General. Kokou, nice to see you this morning. Listen, you've heard Steve and I just chewing through the implications for different asset classes of both this economic rebound and then ultimately concerns about a return to subpar growth trends. What do you think happens in the third quarter as we begin to see some of this government support wash out?
Well, I think the government and central bank will be very practical and dynamic. I think it is also very important to remember that we tried the invisible hand as Adam Smith in the 1929, and that led to the Great Depression because markets cannot be let alone or left alone to deal with these imbalances. So we clearly have the visible hand or the visible fist, if you will, of government and central bank to the tune of $25 trillion to save lives and avoid the world economy going into a massive depression with massive defaults caused by this pandemic recession. So now we have pretty much succeeded in avoiding the deflationary trap or gap, if you will. And therefore, the government and central banks, after this $25 trillion of liquidity injection, are fully aware that it is clearly the worst time to sort of jeopardize that recovery. So the exit will be very gradual and be data dependent. So you were talking about the yield curve, what it is telling us. It is clearly an equilibrium between distorted factors by the central banks, but also fundamental factors. And I think the market is fearing that we might be entering it into an environment of lower growth going forward, and that the tightening cycle is effectively will choke off that sort of fear of high inflation. So in a nutshell, I think the Fed ended up being fed up with inflation fears, pun intended.